Hello, everyone, and welcome to Personalize and Customize your UMPIP, the first in the 2023 quarterly UMPIP webinars. My name is Frank O'Brien. I'm a benefits educator here at Wespath, and joining me today
is Cheryl Hatcher, Senior Benefit Plan Specialist, also here at Wespath. Great to do this with you, Frank.
Yes, we're very happy to get started in our 2023 series. The title for today is Personalize and Customize Your UMPIP. What we're really trying to do and how we're trying to roll out these webinars for you is to really get you to understand how best to take advantage of UMPIP for yourselves, your household for today, and how you make your contributions, how you're saving in our investments, and how you're preparing for your future retirement. So we really try to customize this and tailor this for your understanding of UMPIP. This is the benefit education team. There's Cheryl and I on the right-hand side. Bob Christoffel is the manager of benefits education, and Todd Creviston is also a benefits educator. Those two gentlemen are actually at different annual conferences today, providing the retirement class of 2023 with their retirement seminars. So for today's purposes, on your right-hand side, you can see there is a question box. Please feel free to put your questions into that question box. Sometime after the webinar, Cheryl and I will get back to you with the answers to your questions. But right now, due to the time of year that we're at, we don't have staff here to answer your questions real time. But please use the question box. Just a quick refresher of Wespath Benefits Investments. We are a not-for-profit organization. Our charter, what we are here for, our mission is caring for those who serve by providing investment and benefit services that honor the mission and principles of the United Methodist Church. We are a very large organization. We have approximately $24 billion in assets under management. We are the largest reporting faith-based pension fund in the world. We have over 100,000 participants. That includes all of us here today, clergy, lay employees, surviving spouses, and others who have the opportunity to participate in UMPIP and other plans and benefits that we provide. For today's agenda, today with the Personalize and Customize, we're going to be focusing in on the contributions, the contribution types, the account types that you can contribute to, spend some time on retirement savings or retirement plan concepts, and spend some time on the investment funds that are available to you in our program, LifeStage Investment Management. I will hit on account access, and we will also talk about participant experience, the resources that are available to you. At the conclusion of this webinar, within 4 or 5 days, you'll receive a survey in an email requesting that you fill out the survey to give us feedback as to what you would like to see us speak about in the future 2023 quarterly UMPIP webinars. So please feel free to put in all of your ideas. Give us honest feedback as to how you think today went, how the presentation went, the information was provided. We want to hear all of that to continue to improve this for you all over time. So please, when you get that survey, feel free to fill that out, and we'll take the results from that and apply that into future webinars. So what is UMPIP? The United Methodist Personal Investment Plan, or UMPIP. Our acronyms do come into play here. It is a defined contribution 403B plan. It is a qualified retirement plan under law and regulation. It's a 403B plan. We are a not-for-profit. Those are the types of plans that we're able to use. Many of us are familiar with the 401k that's in the private sector. Same type of plan. It's an account balance plan. What you're going to hear about today is you contribute on a per payroll period basis, contribution dollars going into the account type of your choice. And then it gets invested in the Wespath family of funds. You can direct how you want those contributions to be invested. The participant contributions and any employer contributions that Cheryl will review with you are going into the account balance, invested for the long haul through our investment funds. When we talk about personalize and customize, how each one of you can think about how you want to take the best advantage of UMPIP now, mid-career, later in career, getting ready for retirement. We're going to talk about these types of ideas on the left-hand side. We have the contribution type. You're going to hear about the before tax, the Roth account, or an after-tax contribution account. And again, these are the types of accounts that come through payroll processing. And then Cheryl will spend some time talking to you about the rollovers to UMPIP, your ability to roll other qualified employer retirement plan account balances into UMPIP. There are some tax efficiency strategies that tie into the contribution account that you elect. If it's all before tax, you are deferring taxes now on the contribution and on the earnings, and then it gets taxed in retirement. But with the Roth account, you're going to hear about if it's a qualified Roth account, then you pay taxes now on the front end, but when it becomes a qualified Roth account, then distributions in retirement can come out tax-free. With our investment funds, you're able to self-manage your investments. If you're familiar with the investment markets and you're comfortable choosing the investment funds for yourself, you're able to do that yourself, or you can use LifeStage Investment Management, which I will refer to momentarily. And then we have a couple of autopilot solutions for you. The first one you see there is auto escalation of your contribution amount. You may or may not be familiar with that. But your particular employer, when they fill out what we call an adoption agreement to start using the plan, can make the decision to have you start out at a particular contribution percentage, for example, 3%, and then each year increase that by 1% to a maximum, in my example, of let's say 8%. So you go into the plan at 3%, you're not really doing anything until the point you get to 8%, it will automatically move there for you. Not required to use it if your employer has elected it, but that's available to you. But many employers do not do that. Many employers just leave it up to the participant to determine how they want to contribute to the plan. So we always recommend that you commit yourself to a similar structure. Come into UMPIP, start contributing what you can. Everybody's cash flow situation, household situation is what it is. Contribute what you can, but try to get into a habit and a routine of increasing that amount over time so you're continuing to supplement your future retirement income. The other autopilot solution we'll review is LifeStage Investment Management. You've seen that a couple of times, and there will be a few slides on that shortly. So now Cheryl's going to walk us through contributing to your UMPIP. Please, take heed with this because there's very good contribution strategies that you can have when you start thinking about which contribution account type works best for you. It could even be more than one of those contribution accounts.
It certainly can, Frank. So thank you very much. So contributing to your UMPIP. There are choices that you have. Now, as far as your employer contributions, this might be something that's available to you. You want to check with your human resource department to see if it is. There are two different types of employer types of matching contributions. It can either be a non-matching or actually a matching. The matching is where the employer is actually putting in that extra amount also, if you are putting in a certain percentage yourself. Frank had just talked about a particular dollar amount or a percentage amount of 3%. So if the employer puts in 3%, or if you put in 3%, possibly the employer will match that 3%, so you'll actually have 6% then going into your retirement plan. Hey, isn't that a great thing? Doubling your money. So, and that's all there for you in your retirement. The other one would be non-matching. That would be just having the provider, your employer is actually having the plan available to you, and you can put the money in yourself. Still a great thing to do for later on in your retirement for your savings. Now again, there might be eligibility criteria for the employer contributions. So again, this can vary based on each employer, but some of that could be based on being a minimum age. That might be 21. Again, this would be set up in that adoption agreement that Frank had talked about earlier. That it could also mean something as such as you have to be there for a certain length of time. Maybe you have to be in that position or in that role for at least 12 months. That could be one of the conditions. Another one could be maybe working a minimum number of hours, such as 1,000 hours per year, maybe 1,040 hours per year. Again, each employer can be different, but these are some of the options that we do see. Now let's talk about your employee contributions. This is the amount that's actually going to come out of your paycheck. You actually have the ability to start right when you start. So your employee contributions can actually be put in from day one. You decide how much to contribute. Do you want that to be a percentage amount, or do you want that to be a dollar amount? Frank had talked about maybe having that percentage amount increase over time. Percentage is actually what we do encourage that to happen. If you have a flat dollar amount, if your salary goes up, that same dollar amount is still going to be taken out, even though your salary increases. So that's why you want to think about possibly doing a percentage amount, and then that extra amount then that you get per year with your increases in your salary, that then will go into your extra amount for retirement. You actually state how how you want your account to be invested. Do you want to have it self-managed, or possibly have it be LifeStage investment management, which Frank will talk about in a little bit? Again, you also decide how to contribute. Do you want to be, or are you an aggressive investor? Maybe you're more moderate or conservative. You get to choose that, and you can change that at any time as well. As far as your personal contributions, you have different opportunities to put in on a before tax basis, on an after tax basis, or even on a Roth basis, which is a form of after tax. Let's get into just a little bit of each one of those right now. So let's talk about that before tax. What you're doing now is you're putting money in from your paycheck on a before tax basis. So that bucket of money that you're putting in, those contributions, as well as any earnings on those contributions, is going to be income tax deferred. Now, what that means then is that no federal or state income tax is going to be taken on that bucket of money until you actually receive a distribution in retirement. So that's your before tax. Now let's talk about Roth contributions. Roth is a form of after tax. So you are actually going to be paying income taxes now on that bucket of money that you designate for a Roth contribution. Those distributions are actually going to be, when you take a tax-free, actually take money out, sorry about that, when you take a tax-free distribution of those contributions, those earnings also on that bucket of money is not going to be taxed. It's going to be tax-free. You're already put money into that account on a taxed basis, so when you take the money out, it's going to be tax-free. There are some qualifications to this. Your first contribution must have been at least 5 years prior to the withdrawal, and you must be at least 59 and a half or older, permanently disabled or deceased. So again, if you have questions regarding Roth, you might want to contact EY Financial Planning Services, which we'll discuss in a little bit. But regarding the before tax and Roth contributions, I'll have an example in just a little bit to show you the differences in those as well. As far as the 2023 contribution limits, these are going to be for the before tax and Roth combined. And we know that these are big numbers, but we're just going to put it out there. You have up to $22,500 that you can actually put into your account. If you're 50 or older, you can actually put in an additional $7,500, making that total $30,000 for your before tax and Roth contributions combined. Now, your amount that you put in for employer as well as participant, that maximum is $66,000 now, or your salary if that is less than $66,000. Now, again, big numbers, we know, but the way we just want you to be able to put in what you can reasonably afford. Now let's talk about those after-tax contributions. If you're contributing more than that $22,500 or over $30,000 when you're over age 50, this is where you can actually put in after-tax contributions. So up to that $66,000 max, or up to the salary that you're making. What you're doing is you're actually paying tax on that bucket of money now. But the difference between this and a Roth is that the earnings that could happen from that bucket of money, those amounts also are going to be taxed in distribution. So the earnings are taxed upon distribution. You've already paid tax on the amount that's gone into it, but those earnings on that bucket of money is going to be taxed. All right, so let's talk a little bit more about the dollar cost averaging. The idea behind dollar cost averaging is the continuous nature of contributing into a retirement plan. As you continue to contribute to a plan, you are buying fund shares or units of the fund or funds you elected to use as your investment in your plan. On this slide, you can see the blue line shows how the share price in our hypothetical investment changes over time, while the gold line represents the amount of shares purchased in the relation to the share price. As we know, the investment markets move up and down each and every day. In this example, we have a hypothetical $500 per month being contributed into a plan. You can see different amounts of fund shares are purchased each month. Some months when the share price has dipped, you will buy more shares. Other months when the share price has increased, you will purchase less fund shares. In down markets like we've had recently, more shares are being purchased, so think of it like a sale, not paying the full price. Studies show that with dollar cost averaging, you end up purchasing more shares over time and, historically speaking, experience a higher rate of return spread of earnings by spreading out your contribution frequency, such as every pay period over time. This is in contrast to a single investment or contribution into a fund, which purchases a set amount of shares, and that number of shares is fixed. Again, history tells us that those shares will also experience earnings from that particular investment. However, through dollar cost averaging, you will potentially experience a higher rate of return than if you do just a single investment into that same investment fund, such as once a quarter or perhaps once a year. Now let's talk about the account growth over time, which is our next topic. This is what we're going to speak about now is the idea of time value of money, also known as compounding. These next slides illustrate what account growth over time may look like under certain conditions. So in this box, the vertical axis shows account balances, and on the horizontal axis shows a person's age. With this hypothetical example, we are making some assumptions. At age 25, we're assuming a starting salary of $35,000, an annual planned compensation growth of 3%, and an annual investment growth of 7%. For the first example, a 25-year-old contributes 4%, and over the next 40 years, the account has grown to almost $410,000, showing the power of compounding, which is the second one actually here. So for that first one that I clicked on, the first example is a different 25-year-old who contributed only 1% over the next 40 years, and the account has still grown to over $100,000. For the third example, a 45-year-old who is now making $65,000 contributes 6%. While this money has only 20 years of compounding, the account has still grown to over $200,000. There are a few things to look at with this final slide. You can see that over time, the amount in your account will grow. The key is not necessarily when you begin contributing or how much you can contribute at any point in time. However, it can be seen the more you can contribute and the earlier you contribute, the higher potential account balance may be available to you for and in retirement. But what the slide is not intended to do is to discourage anyone by looking at the age to begin contributing or the amount of the account on the vertical axis. In our view, it does not matter when you begin contributing or how much you contribute. The key is that you contribute. Every dollar available in retirement matters. So as I previously mentioned, here is a paycheck example for lay as well as clergy employees deciding between before tax and Roth contributions. Lay employees still pay the 7.65% FICA or old age tax when contributing pre-tax to the 403B plan, while clergy are able to avoid the 15.3 SECA tax when contributing pre-tax to the 403B plan. While the Roth, lay, and clergy columns show in this example the 8% contribution after the federal tax is withheld. While this isn't a dollar for dollar savings, having the before tax contributions increases your take home pay, but this money will be taxed when you take a distribution in retirement. Remember that your retirement saving is for the long haul, a get rich slow plan versus a get rich quick plan. To see if Roth contributions are right for you, please contact your EY Financial Planning Services or your own financial planner. So let's talk about rollovers. Rollovers are going to be that portable money that is an IRS qualified plan or maybe a traditional IRA. Money that you have in a retirement plan, maybe from a previous employer. I actually had a couple of IRAs myself, and I was able to roll them over into my Wespath plan here, the plan that we are all in. So as far as the rollovers, there's two different types of rollovers here. We have a direct rollover, which is the more common type of rollover that we have. This is where it's a non-taxable transaction, and you just fill out a form, and we actually have help. I can actually help you through that since I'm the one who handles the rollovers here at Wespath. Or we have what's called an indirect rollover, where the money is actually sent to you, and it could be taxed, and then that money can come over to us. If you have any questions whatsoever regarding rollovers, please contact me and I can help you through that process. Now, Frank is going to be talking about investing your account into your UMPIP.
Thank you, Cheryl.
Okay.
A lot of good information on the slides on personal contributions. Just a couple of things to just point out and maybe echo from what Cheryl had to say. Employers can have eligibility requirements for you to receive the employer matching or non-matching contribution in the plan. But please note that personal contributions, you're eligible to make those upon hire. So you don't have to wait for any eligibility requirements. You can go ahead and begin to contribute your participant contributions. One of the recommendations we always make is if your employer is matching your contribution, you want to try to at least to get to that matching level as soon as possible. If it's 3% on 3%, you can't do 3% right away, you can only do 1 or 2. You still want to strive to get to that 3% to get to maximize that employer matching contribution. The slide here kind of refresh some of the thinking around tax efficiency strategies, some financial planning concepts along the way relative to what makes the most sense relative to you contributing before tax, taking home a little bit more pay, doing Roth. You can always start before tax and then transition to Roth, and the limits are combined, so you can kind of do both. So again, conceptually trying to figure out what works best for you. And as Cheryl said, this is a long haul plan for retirement, so that whole dollar cost averaging, we look at the markets, but in a retirement context, don't fret about the markets, continue to make your contributions. And as we know, even Albert Einstein said the most amazing thing that was ever invented is compound interest. So just know that even though we have market volatility, that the markets will recover and normalize over time. So, kind of stay with it. Contributing to the plan, it's one of the primary things that you do when you go into a plan like this. The other is setting the investments. Where are your contribution dollars going to be invested to provide for you that income in retirement? With Wespath, there are several benefits of investing with us. One is sustainable investing, and that actually means two things here at Wespath. The first is we need it to last for the long haul. We have been around for, I'm going to guess, around 115 years, and we have been providing retirement vehicles and retirement income throughout that time period. We're doing it today, and we have every intention of doing it long into the future. But sustainability also means our philosophy towards the investing. We are an ESG, environmental, social, and governance-oriented type of investing house and denomination. So when we look at sustainability, we're looking at the important aspects of where we are relative to climate change and social justice issues, DEI, etc. So what we're trying to do is make sure that these accounts can hold up over time, but also uphold the values of the United Methodist Church. I'm going to review with you the investment funds briefly. We have a diversified set of investment options. Diversification is one way in which you can eliminate risk and get some more potential growth. We're going to go through income funds or bond funds, equity funds, stock funds, a capital preservation fund. Because we are who we are, we have competitive returns relative to benchmarks, low expense ratios, and no commissions. We are a not-for-profit organization. We actually have the principles of our denomination kind of underpinning everything with us as well. We do not pay out any commissions to anybody who works here. We do, however, look at the investment funds that we have, and we make sure we compare them to like investment funds in the marketplace. So a fixed income bond fund against fixed income bond funds, U.S. equity funds against other U.S. equity funds, and we do very well against these other funds in the marketplaces. And because of our size and because of our approach, we have low expense ratios, which means very low amount is coming out of the funds to pay for the overhead, but for all the programs and plans that we have, that overhead is actually covering all the costs of that. And we have LifeStage. So to quickly go through the investment funds. We're going to go by category, which is in the blue button there, if you will, and then the funds themselves. So the first is the Capital Preservation Fund. Our fund is the Stable Value Fund. The words are kind of telling us what's happening here. Capital preservation, similar to a money market fund. You have a low rate of interest with a low possible rate of return, but you are preserving that capital for particular needs, and in our environment, as people get closer to and into retirement, to make sure that there's a pot of assets available to them to receive their income. We have 3 income funds or bond funds. The first is the Inflation Protection Fund, and this fund is intended to purchase securities that keep pace with the rate of inflation in our economy, so that as we're investing in this fund, and the inflation starts to move around, that the performance on that fund comes close to matching what that inflation rate is. We have the Fixed Income Fund. This is one of the largest funds that we have. This fund invests in a broad array of different types of bonds and bond-like securities. So it could be U.S. Treasuries, it could be sovereign treasuries from other countries, it could be corporate bonds from other countries, and a combination of those types of investment vehicles that make up the fixed income fund. Because there's a broader array of the types of investments that go in there, there's a higher degree of risk with a higher degree of potential rate of return. And the third is the Extended Term Fixed Income Fund. This fund is kind of sectored in such a way that we're looking at what they call the long range of bonds, 10-year bonds, 30-year bonds, and we're investing in those. And because nobody really understands what the interest rates and the market's going to look like 10, 30 years down the road, there's yet a higher rate of risk in this investment fund with a higher rate of potential return from the fund. But still, income is the goal, and bonds are the primary investments that we have. Looking at this screen, we'll go to the bottom first, the equity funds. We have the U.S. Equity Fund. That is a company stock fund. That fund is buying U.S. domestic companies, large companies, mid-sized companies, small companies. Companies they consider to be growth companies, those that are doing very well and growing over time, a lot of technology companies, as well as value companies, companies that people think are undervalued or have a better rate of increase in the future for their price, so we will put them into the fund as well. It's a company stock fund, is a higher rate of risk, higher rate of potential return. And then there's the International Equity Fund. This is a company stock fund of companies that are outside of the United States. So, Siemens over in Germany, Sony over in South Korea, those types of companies come into this particular investment fund. But again, large cap, small cap, mid cap size companies, growth companies, and value companies all blend in that. There's more risk with an international equity fund than a U.S. equity fund, but there's a greater potential rate of return. And then bring you back up to the top. There's a thing called a balance fund. It's a fund that holds both stocks and bonds. It has the goal of both growth like stocks and income like bonds. And the way we do it here, which I think is very smart, is we use a fund of funds approach, where we're using the funds that we already have in place to devise the allocation mix between equity and bonds that we want to have. And you can see on the screen, we have 65% in equity funds between the U.S. equity and international, and we have 35% in the in the bond funds. We have the fixed income fund and the inflation protection fund. So that fund works with a diversification that's just built into how it's made. We've got the equities, we've got the income, but this is fixed. This is going to try to stay 65-35 over the long haul. We also have the Social Values Choice suite of funds, and these are funds for participants with a heightened focus on the company's environmental and social performance. So we always apply those principles as we develop our funds, but we have another subset of funds where those principles are even applied a little bit more stringently. The types of company stocks coming in or going out of the fund, or bonds going in or out of the fund, is usually decided at a higher level, like the annual conference level or a UMC agency level. These funds are also available to you if you self-manage your investments. So we talked about risk and return, and this is a visual of risk and return. The Stable Value Fund towards the bottom left-hand side there. It's a fund that's got a particular purpose. Younger individuals, maybe not thinking about it so much, but certainly for people getting closer to retirement, they may be. Low risk, low rate of return. But as we go up that scale, you can see that we start to bring on more risk with more potential rate of return. And that includes our income funds. So we have the fixed income fund, the extended term fixed income fund. They are bond funds, but they have a degree of risk with a potential for return. And then we finish that to the right-hand side going through our equity funds. Equity funds have the highest risk profile, if you will, but again, the potential for a higher rate of return. But as we know, and we certainly know over the last several years, that this isn't fixed in stone. It can turn around and go the other way as markets get more and more volatile. But this reflects the historical performance of these types of funds, these types of assets. And you can see kind of the glide path here going from top right down to the left, and I'm going to reference that when I talk about LifeStage Investment Management. Here, you can see both options that you have in terms of participant-directed investments in the plan, how you can personalize and customize. On the right-hand side, you can choose your own mix of investment funds. There's a lot of information available to you on these funds on our website. You can make the determination as to what funds you want to use and what percentages and how you want to set that up. Or LifeStage Investment Management, which is the next topic we're going to get into. But we believe, regardless of which side of that you want to go to, we think it is a good idea to have a conversation or a consultation with EY Financial Planning Services, who we partner up with that can provide for you holistic household financial planning services to help you think through how you want to invest your contributions in the Wespath funds, not just now, but periodically touch base with them again and continue to have that conversation around how you're, quote unquote, positioning your contribution accounts in our funds. And if you're using your own personal investment advisor, same thing, speak to them and make sure you all have a comfort level relative to how the accounts are being allocated. The cliche is you want to be able to sleep at night, so having a good understanding of where they are, EY is a good resource for you. So now we're going to talk about LifeStage Investment Management. LifeStage Investment Management is a program that we have where you're asking us to tailor your investment elections for you over time through the long haul, getting toward, to, and through retirement. This is a personalized investment management program that we have for all of your defined contribution accounts. Once we set it up, it goes on autopilot, and I'll explain how that works. And we're tailoring the investment allocation to you, the participant. We're looking at your age, your marital status, expected benefits commencement date. If you're lay, we assume Social Security benefits. If you're clergy and you tell us no Social Security benefits, we'll use that. We'll look across the Wespath benefits to see what else you have. But also, we'll look at your risk tolerance. This is somewhere where you can kind of turn the dial on how you want to use LifeStage Investment Management. You can be a conservative investor, and we can set up a conservative-oriented type of investment allocation. You could be moderate. You could be aggressive with a little bit more exposure to the equity funds if you have more of an aggressive type of risk tolerance. That is an area that you can tell us how you want LifeStage to be set up. And what LifeStage will do is we set up an allocation for you. Let's say it's 60-40, 60 equity in the 2 equity funds, 40% in our bond funds. And as we age up, the amount of the equity exposure slowly comes down, the amount of fixed income exposure slowly goes up, because we want to manage that account to get you into and through retirement. So somebody who is 50 years old might be 70-30, and at 60 years old might be 60-40, and at 65 might be 55-45. But we're managing all of that throughout the course of their time with us in the plans and in the investment funds that we have. And that's one feature of 2 features of the program. The second one I'll get to momentarily. But we're setting that up and we're managing that for you over time. We create a diversified investment portfolio. Again, we're looking at each individual participant. We set an asset allocation, and we will review that for you on a quarterly basis. So we rebalance your account as needed. So what does that mean? Let's say we have set you up at a particular age or particular time at that 60-40 percentage, 60% equity, 40% fixed income. But the markets change all the time. So maybe you get to 70-30. Well, what we want to do is we want to get you back to 60-40. So we're going to get rid of some of that excess equity and bring up some more of that fixed income side. Or maybe you went to 50-50. We're going to get rid of some of that income side to get you back up to the 60% on the equity side. And we do that throughout the course of the year. Now, when we say quarterly, it's not the first day of a particular calendar quarter. What we do is we look at your birthday. And off your birthday, on a quarterly basis, we build that review of your account and rebalance as needed and as necessary. So we're managing the investments during your active service as well as getting you to and into retirement. So this is the rebalancing example that I just went through. Before the rebalance, you had your equities of 36% or 46%, and 54% was in the fixed income, but we didn't want that. We wanted to set that up to after the rebalance on the right-hand side. So there's 2 features to the program. One is for the long haul. We're looking at your allocation, and we want to make sure we know where you are relative to future retirement and income use. But we also want to know where you are in the present tense in the year to make sure that we keep you within the range of the investment allocation that we want to have you in. And both of those things make for a very, very powerful program with the potential for a higher internal rate of return because we are managing and balancing that over time. Now, many of you may be looking at your participant statements online because we're putting them out online for you on Benefit Access. And you may be seeing all these interfund transfers going on page 3 or page 4 of the statement, and you have no idea why. Well, what we're doing there is we're doing that rebalancing of the account, either the quarterly rebalancing based on being out of sync, or we just modified the modification because we're aging up. Many of you may be in LifeStage investment management and not actually be aware of it. You've started to contribute into UMPIP. You've gone through UMPIP for several years. You're seeing these transfers going on, but you're not really sure exactly how it's all set up. What we will do is we put you into a default position in LifeStage investment management. We make some assumptions. You're going to retire at age 65. You're going to receive Social Security benefits. But most importantly, we have you as a moderate risk tolerance. Not a bad thing. It's kind of right down in the middle there. It's a nice swim lane to be in. But just note that you can always change that on Benefit Access to conservative or to aggressive. If you are to do that, we're going to wait until that quarterly anniversary of your birthday and then look at your account. And if you made that request, we're going to do it at that time. So if you go in after this webinar and make the request, you may not see that on your 331 statement, but you'll see it on the next anniversary of your birthday. Okay, hopefully that made sense. On Wespath.org, and Cheryl's going to share more with our participant experiences, but I like to say we have a plethora of information available to you around our investment funds. These funds are valued on a daily basis, so you can see what the price is on a daily basis. We have short executive fund descriptions and very long in-depth fund descriptions for you. And then you can see how we're, setting ourselves up on a comparative basis against benchmarks with our peers out in the marketplace. You can see the fees or operating expenses that are there. Again, we have operating expenses. They're relatively low on a competitive basis, and they are kicking off and paying the overhead for Wespath, including the LifeStage Investment Management Program. There is no cost to you to take advantage of that program. Now, very briefly, I'm going to talk about accessing your accounts, but one of the subsequent 2023 webinars, we're going to spend more time on accessing your accounts. We call the segment Life Happens. But today, we want to emphasize getting into the plan, contributing to the plan, and investing in the plan, and all of that. But also, we know that there are times you may need to access the account. So under certain conditions prior to retirement, there could be a termination, separation of service, certainly at retirement. Briefly, the options that can be available to us. There's hardship loans. So maybe somebody needs to take out, $8,000 to fix the roof or something like that. You may not necessarily have to take a distribution, pay taxes and all of that on it. You could just take out a loan for 5 years, pay that back to yourself with a rate of interest. So you're getting some of that interest you lost by not being in the funds while you have that loan. There's a thing called hardship withdrawals. This is before you are age 59 and a half. That's a magic number in the retirement world, where under certain conditions, you take out a distribution from your participant contribution account. It'll be taxable with a tax penalty. So if you think you need to access the accounts, you certainly want to call us, call EY, and talk that out first. Cheryl talked about the rollover account. You bring the rollover account in. If you need to access that, we'll provide a withdrawal form for you. You can withdraw some or all of that rollover if you need it. If you're under age 59 and a half, it's going to be not only ordinary income, but it will have that 10% penalty attached. But on the other side of 59 and a half, that 10% penalty goes away. Other restrictions go away. So the rollover account, you don't have to worry about it anymore. With the in-service withdrawals, you're over age 59 and a half, you can come and receive a distribution from the account without justifying to us, like a hardship withdrawal. You don't have to justify to us why you're taking out that distribution. Due to disability, qualified military withdrawals are also available to you. And again, in a future webinar, the second quarter, third quarter, what have you, we're going to go into more detail as to getting access to these accounts when life happens. And now, to bring us home, Cheryl's going to review with us the resources that are available to you. In many ways, this is just touching the surface, top of the iceberg, tip of the iceberg, if you will. There is tons of resources, educational opportunities for you, one-on-one consultations that Cheryl's going to share with you. So,
all right, take it away.
Take it away.
All right. Well, here, so thank you very much, Frank. So let's talk about some of those resources. Frank touched a little bit about benefits access. You can actually reach benefit access in two ways. Go to benefitsaccess.org, or you can actually go to wespath.org, and on the upper right-hand corner, there's a box that you can click for benefits access. So again, a lot of information is out there. To rephrase Frank's word, a plethora of information is out there. Account information, you want to see how much you have in each of the plans that you have, you can see that there. Again, once you receive an email from us that your quarterly statement is due or it has been completed, you can actually see it out there as well. Projection tools. We've got the benefit projection tools, which are very popular. You can actually run those yourself, run different scenarios for you. Maybe you want to retire now, maybe you want to retire in 3 years. You can see what the difference would be in your annuity payments, or how much you would have in your UMPIP accounts. You can actually update your beneficiaries. Hey, they move. I know kids move around. You want to make sure that information is updated accordingly, so that the information and any account balance information after you pass will go to who you actually intended to be. Lots of different educational information and investment information is out there. In that box on the left-hand side, it actually says learn more. All of those are questions. You can click on all of those, and you can get lots of information regarding the questions you have, or the information that's there. So again, a lot of great information there on benefits access. EY has been a fantastic partner of ours for well over 16 years. They offer confidential, professional, one-on-one guidance for you. If you already have a financial planner, that's wonderful. Now we like to say you have two. This is one that you do not have to pay anything additional for. The fund actually pays the services for EY, but they have a bunch of different calculators and tools and resources that's out there. Highly worth the time it's going to take to actually go out and set up your account with them. Their website is there, wespath.eynavigate.com, as well as contacting them via the phone. You can have as many conversations with them as you'd like. There's no question too big or too small for them. And here's actually some consultation topics that you can actually deal with. You can actually go through a retirement plan with them. That's what they're there for, but they can actually help you with lots of different things. Maybe you're thinking about buying or leasing a car. We actually had a couple of our educators do that. They called them up and said, what would be best for my situation? And they wound up helping them with that answer. Maybe you're wanting to take care of grandchildren, or maybe a niece or nephew, maybe with their funding of their education. You can ask them about that as well. We had talked about Roth as being an option that maybe you want to participate in. Contact EY and see if maybe that would be an option for you. So everybody's situation is different, so they can actually give you that guidance to be able to help with that. Managing debt, is it best to actually maybe pay off your house now? Maybe you have a lower interest rate, so maybe you want to keep a hold of that and put more money into your retirement. Those are just lots of different options that you have. So again, we like to say that no question is too big or too small for them to help you answer. Here's a few of those upcoming EY webinars that are coming up for them. So we've got information there for April, May, and June. Highly encourage you to go out and look at those. They've got different times that they are available, but then they also do recordings of them, so you can always look back at them if you happen to have missed one or have a topic that you want to look back on and actually listen to. We also have our Wespath virtual one-on-one consultations. This is where you actually meet with one of our Wespath educators. Could be Frank, could be myself, could be Todd, who is in that laptop right there, Todd Krivison, or our manager, Bob Christoffel. Any one of us will be able to give you a personal, confidential 30-minute consultation, and you can go to that by clicking on or having that link and actually click on the date and time that would be best for you. Now, it wouldn't be one of our webinars if we didn't talk about action planning and next steps. So if you haven't already, we highly encourage you to, of course, enroll in UMPIP. Take a look at that elect your contribution amount. Do you want that to be a percentage or a dollar amount? Again, we do encourage the percentage to have that money increase over time. But again, whatever is best for you, that's what we want you to take away from this. Find out if your employer matches. So again, if they do, if you can, contribute at least that amount or actually build up to that. That would be great if you could do that. Otherwise, you're taking advantage of the employer match and then they're actually putting more money into your retirement plan for when you have a salary in retirement. Determine your investment strategy. Do you want to be moderate, conservative, or even aggressive? And again, that strategy can change at any time. I actually changed mine from being moderate to aggressive. Figured, okay, let's get a little bit more or aggressive in my investments. So again, I actually did that during the weekend during the Super Bowl. So you can do that at the leisure at home or actually online. Again, register for Benefits Access if you haven't already. A lot of great information out there, a lot of good tools, resources available to you, and it's just a wealth of information out there. EY Financial Planning Services, we can't say enough good things about them. They're a great partner with us, and also our one-on-one benefit education consultations that you can schedule to have educational consultation with us. And here is a great slide to actually take a picture of if you can. Go ahead and take a picture of this. This actually is great information regarding all of our options or resources available to you. Our participant solutions team or customer service team, they're available for you at that number there. Wonderful team. Can't say enough good things about them. If you're retiring soon, they can actually help you with that as well. Benefits access, go out to that website and actually poke around. You can't break anything. Just go ahead and poke around and see what kind of information you can find. And then also EY Financial Planning Services with their phone number and website to get a hold of them. All right, so this is going to be ending up our discussion for today. So Frank, it's been great actually talking to you with this information for UMPIP. So what other information do you want to say?
Well, we just want to thank you for spending some of your time today with us, allowing us to share with you UMPIP. Some of the key features, over the course of the year, you'll be hearing more and more and more about UMPIP. We wanted to start the year off just with the concentration on contributions, contribution types, as well as the investment funds. This webinar is actually being recorded, so you will receive this on the registration list. Everybody who registered will receive a recording of this, a PDF of the presentation deck, as well as that one-on-one benefit education consultation link. And what we have found over time is people like to come to us for the one-on-one consultation, then go to EY because they feel they're better prepared to ask the questions they want to ask of EY when they spend time with their consultants.
Correct.
The question box, if you put questions into the question box, and hopefully some of you have, we will get back to you within the next several days. And the survey, when you get an email from probably Cheryl with the survey attached to it, please take the time, give us the feedback, and give us some ideas for future webinars, because we certainly want to integrate what you all think UMPIP is, what it's about, and what you're trying to get out of it. We don't want to be the ones thinking we understand what our plan is and what we want to give to you. So we want it to be interactive in that way. So please fill out that survey, send it back, and we will be reviewing it and integrating some of those ideas into future webinars. And then I think with that, Cheryl, we can wish everyone a good rest of the day.
Yes.
Thank you again, and we'll see you again down the road.
Thank you so much. Have a great day.